Hello and welcome back to the Trinity Student Managed Fund podcast with me, Emanuele Roncalli di Montorio-Veronese, where I speak with leaders in the world of business, finance and technology to give our students a better insight into the careers we may wish to pursue. Today's episode is sponsored by Setanta Asset Management, a Dublin-based boutique investment manager specialising in equity and multi-asset strategies with a fundamental value approach since 1998. With a proven track record of strong performance and 13.2 billion euros in active assets under management, Setanta serves a diverse client base, including institutional insurance, pension funds, charities and family offices across Ireland, Germany, Canada and the United States, applying a long-term investment philosophy that clients value. Today, I sit down with Sandra Robertson, who is the founding Chief Investment Officer and Chief Executive Officer of Oxford University Endowment Management. Oxford University Endowment Management manages the Oxford Endowment Fund, whose investors include the University of Oxford, Oxford Colleges and Trusts, and other UK charities. The Oxford Endowment Fund is invested globally and across asset classes. Prior to Oxford University Endowment Management, Sandra was at the Wellcome Trust from 1993 to 2007 in various roles, including Head of Private Equity, Head of Alternative Assets, and most recently as Co-Head of Portfolio Management, sitting on its investment committee from 1997 to 2007. Sandra is a Fellow at Oriel College, Oxford, a Commissioner for the Royal Commission of the Exhibition 1851, and a member of the Investment Committee of the Nature Conservancy. Sandra has been recognised by several industry awards for her expertise in endowment investing, including a Private Equity Trailblazer Award from Women in Private Equity, Power 100 CIO, Top 100 Most Influential Women in Finance, and 100 Women in Finance's European Industry Leadership Award. I hope you enjoy this conversation with Sandra Robertson. Okay, so Sandra, welcome to the Trinity Student Managed Fund. Thank you so much for taking the time to come on.
Well, thank you so much for inviting me. I am absolutely delighted to help in any way I can.
Thank you so much. Great to have a sister university come on the podcast, which is great. So, Sandra, I'd love to start with you on a more personal perspective, and I'd love to know, about what you were like growing up and at university and kind of what sparked your interest to go into the world of finance and investing.
Well, yeah, I think you'd have to ask my brothers what I was like growing up. But I grew up in the west of Scotland. I went to a local state secondary school. We were super lucky. It was actually quite a small school. And in Scotland, you can do secondary school from the age of 12 to 18. So we don't have further education colleges the way that they have down here in England. So I was able to complete my whole education in the one school. I was more interested in being a ballet dancer, really between the age of 8 to, I suppose, 12, until I realized I wasn't good enough, which is always a disappointment. And so for me, in choosing my university degree at that point was I had moved from being a ballet dancer to wanting to be a journalist. But my father was a little against that. So he said, go and get a general business degree, go and something that gives you lots of options. And it was actually turned out to be super helpful for my career. I did a bit of corporate law, corporate finance, marketing. It was the very early days of spreadsheets. We had no idea what we were doing when we saw our first spreadsheet. It seems so long ago. But yes, the university was quite good. It was a sandwich degree. So I had a year out. I was lucky enough to be picked to go and work for Conoco. It was an oil company based in London. So going from Edinburgh to London was quite exciting, as you can imagine. And the oil industry at that time was booming. It was thriving. And there was a lot of what we call placement students at that time. So there was a great community for us as well. And they were all very generous with their time. And really, they let the students do all sorts of things and even gave them some real jobs. So it was a great experience for me in the real world.
And did you have mentors there initially?
I did. I think I had one or two. There was the head of the financial accounting team. He was brilliant. I can't remember his second name now, but his name was Nigel. And he very much believed in giving his students responsibility. But, I suppose we did muck around a bit as well. But it was good. They were very generous with their time, and all the way up to senior management. It was an American company, and we'd often get people coming in from the US, and you would get to spend time with them, and that was really important.
And all the way back then, was there any advice that still resonates with you now?
Not specific at that point. I suppose it was just work hard and ask questions.
And when you were kind of entering the world of investing in finance, were you drawn by, any particular asset class, or, did you go in and think, okay, FIC is really interesting, or equities, or was it not that clear cut at the very start? Just
No,
because
I think I've said this before. I really am an accidental investor. When I graduated, I worked for I temped. It wasn't a time of full employment. It was actually quite hard for graduates to get a job in the UK. And I temped for a bank in Edinburgh. Its international division was in Edinburgh, so its currency traders were all in Edinburgh. And it was actually during the period where Britain came out of the exchange rate mechanism, and overnight interest rates went up to about 15% in the UK. So that temp job really exposed me to, I suppose, currency trading, and really gave me an insight into what I had studied, with the various theories that you do in economics as well, into real world practice. I saw that unfold in front of my eyes. I left Edinburgh to come to London. I was going to go travelling and ended up going for a temp job at the Wellcome Trust. Nobody had really heard of it at that time. It had just a large share placing, so it had around £2.5 billion in the bank, and they weren't entirely sure if they needed a full-time investment team. So I turned up for an interview and was lucky to be given, I think, an initial contract of about maybe 6 months at that point. But it really just went from there. And so the Wellcome Trust was my first experience of investing. And it was, blank sheet of paper, £2.5 billion in the bank, and really entrepreneurial leadership to get us going.
Could you talk more about your time at the Wellcome Trust? Maybe some lessons that you learned there, and
So I think for us, we were an institution starting out. There was nobody like us. We weren't a pension fund. The money that had been gifted, that we'd raised from the sale of shares, was precious. There was no more money coming in, so to speak. So we had very much what I would call an absolute return mindset. What we also learned was, at that point, the Wellcome Trust was run by what they call governors. They were all leading scientists in their field. You don't really get to be a leading scientist unless you're a bit of a maverick. And so we would take things, new ideas to them, and say, could we invest in this? And they'd show you, well, tell us the logic, show us the facts, and explain your thesis. And never once did anyone in that institution say, well, you can't do it because other people aren't doing it. So for us, the lessons I learned at Wellcome was that, focus on absolute return, explore new areas, be intellectually curious. Don't worry too much about what other people are doing. You have to be aware of what other people are doing in case you're going down completely the wrong path. And if you can find smart people to talk to, learn as much as you can from them. And the people we learned to talk to at that point were in the US, lots of US institutions. It's a well-trodden path in the US, investing foundations, endowments. And at that point, really, Wellcome was the only significant investor with a perpetuity mind frame that wasn't, well, pension funds aren't perpetuity investors, but so, learn as much as you can from people that are brilliant at their jobs.
And I'd love to talk about now your investment philosophy, your investment framework, and I suppose your approach now. How did that start? How does one make their investment approach and framework and philosophy? And for you, how does that change? How has that changed over time?
So I think if you start with the first thing is the type of money that you're managing and what is the time horizon for the money that you're managing. So the way that I would manage my personal money being completely different from the way that we manage the endowment fund. The endowment fund will exist in perpetuity. I don't think I will. Don't think the science is there yet. So for us, it's coming to the University of Oxford. It is a global brand. So we think through what are our competitive advantages. And this applies, I suppose, to any pool of capital that you're running. So understand the time horizon, understand the purpose of the money. So for us, we're looking to provide a sustainable distribution each year so that our academics and students can be funded on a regular basis without too much volatility. So that certainty of the annual distribution is really important. So we got the time horizon, we've got the purpose of the money, and then we looked and we said, what are our competitive advantages? So our competitive advantages, people have heard of the University of Oxford, and that's super important for access. We've got a very long time horizon, so year to year, month to month volatility doesn't really matter to us as long as we can meet our annual distribution. And then for a smaller group like us, we knew we couldn't create a global diversified portfolio with internal staff. So we really wanted to have this type of strategy. So we knew we would have to use external partners. So a lot of our time is spent trying to find really great investment talent. And there's a lot of people investing, but there's not that many truly talented investors. And brilliant investors whose interests are aligned with yours, which is really important, tend to control the assets that they manage, and they tend to pick their investors because they can. So having that global brand, having that long-term horizon, we have been able to build a portfolio of exceptionally talented people investing in a wide range of strategies globally. So that comes over time. I would say what's evolved, what's changed is there's a lot more people doing this now in the industry. There's a lot more perpetuity pools of capital. There's huge sovereign wealth funds. They exist in perpetuity. You've got these incredible Australian and Canadian pension funds as well. They have a super long-term horizon. So there's a lot more capital today in the business than when I started. Private equity is an asset class today. It was a bit of an experiment when I started. And, you know, I think that things evolve, so you have to evolve your knowledge of particular strategies. But I think a core essence, certainly with us in the endowment office, we really are intellectually curious. We really want to understand how businesses work because you can have good conversations with your fund managers then. And we also are not scared of making long-term investments. So venture capital can take 15 years actually to do anything. If you don't have that stomach for that type of, you know, long-term duration, it's not really an area that you should be in.
And from your investing experience, you've got such a wealth of over 30 years of investing experience. I'm sure you've seen the dot-com bubble, the GFC, and so much more. Are there any key lessons you could, bestow upon students now in university going into this world of investing in finance, which you think are really important?
So one thing I'd say is don't be afraid to stand out from the crowd, because the best investors I find don't really care what everyone else is up to. They are very focused on what they want to do. I think study history, because people don't learn from history. So you do get bubbles, and make sure you're on the right side of those bubbles. I would say understand what your competitive advantage is, and valuation matters.
So on that quickly, because I was just reading, yes, I study history myself, and I was studying the 1720 South Sea bubble. and they talk a lot about, valuations at the time. Not to move directly onto markets yet, but I'm just wondering, how do you view valuations now in the equity markets? I know this is a topic of big debate. I'd love to know what is your kind of perspective on the tech valuations and
So I
in the
think
US specifically. Yeah.
yeah, so I think people like to generalize. But there's this sort of magnificent seven that everyone points to. I think you've got to take a step back and instead of grouping them all under one area, is to say, look at the individual businesses, look at their growth rates, look at the people managing the businesses, are they good capital allocators? Look at the industries that they're in, the markets they're addressing. Are they growing? You have to be comfortable that you are making an assessment of those growth rates and the revenue rates and the profitability, and then make an assessment as to how much you're willing to pay for it. Some people are less sensitive to that. They just, they want to ride the wave. But, there's no doubt I'd say the markets are very concentrated. And what you often find, being a student of history, is people often pile into things after they've gone up. And that's not to say they can't keep going up, but if you can be slightly before the crowd, and I think that's the place you want to be. But I think market concentration today is an issue, and so many other companies just get forgotten about. But yeah, I mean, you see this, you saw it with the dot-com bubble. People were talking about eyeballs to justify valuations. Ultimately, it comes back down to cash back to investors through dividends or through growth. And you've got to be pretty confident of those growth rates.
And in terms of idea generation, you've mentioned the importance of, thinking differently, maybe having a contrarian view. What does that look like at the endowment? What is the research and kind of idea generation?
So I think for us, we don't invest across great themes. I think what we say is we want the portfolio overall to be growth focused because, we want to be around forever. So we want to be these companies that are growing. And we want to have exposure to a range of different strategies. So we have quite a big allocation to venture. Why do we like venture? Because you get an allocation to innovation. I think it's quite hard to figure out where the next wave of innovation is going to come from. So if you can, for us, back venture capitalists who can attract the best entrepreneurs, because ultimately it's the entrepreneurs that come up with the ideas, not institutions like us. So you want to always be with the best people who are generating great ideas, and also, be patient and be willing to, not all these things work. So in our private portfolio, we really like to back innovation. We like to back people who have some form of operational expertise. So it's just not financial engineering. So we get exposure to companies being turned around, growing, real revenue growth. And that's a very exciting place to be. You're at the sort of the edge of capitalism, innovation, new company creation. And then on our public side, we tend to invest in people who can look at the world and who are not stuck to one country or one sector. So we like to allocate capital to people who are just looking for the best companies globally.
And in terms of the investment committee, what do you think are the key characteristics that make a strong investment committee? And as a leader of the investment committee, how do you influence that?
So with an institution, you have to be quite careful when you're talking about an investment committee. So OUem itself doesn't have an investment committee. So the investment team make the investment decisions. But we work very closely with the university's investment committee. And they have got a fantastic group of very experienced investment individuals. Committees themselves don't make decisions, I don't think, don't make good day-to-day decisions because that's not their job. But from my experience with the university's investment committee, they're fantastic sources of advice. Their role is to oversee us. Their role is to challenge our overall policy, how we think about the world. And why wouldn't you use that expertise? So I think it's really having a clear mandate. Everyone understands the roles. I think that's, if you have a committee who really understand the role, us as an investment team, we understand our roles. And, the day-to-day blocking and tackling is done at the people, decision-making is made by the people doing the work.
And in markets now, are there any areas that you're looking at that you find quite interesting that you'd be willing to talk about?
So it's really interesting. Markets is such a small word for a big opportunity. We tend to be led more by investment talent. We don't sort of have a big matrix of asset classes and boxes that we fill. We are open to looking at any types of deals. At the moment, we're looking at a couple of property transactions that we can really use our time horizon to benefit from. I know the guys have been working very closely with that. We've been backing a little asset management company, helping them grow their business. We've been taking in our big global equity portfolio. We've been trimming profits from people who've done really well this year and putting it into a different type of strategy. Credit's an interesting space. We're keeping an eye on that. There's always lots of things happening there, whether it's in the public side or the private side. So I don't think we've got great themes or asset classes. It's very individual opportunity driven, I would say. And there's always stuff to do.
And how do you approach risk management? Like what are the key metrics that you look at? And maybe some risks in the world today that you're thinking about, or the endowment is thinking about?
Yeah, so when you're an endowment, your biggest risk is that you don't preserve the real value of your investments over time, and you don't grow that by at least inflation. So that's why we want to be in equities and real assets. We do want to protect the real value of the overall fund. What worries us at the moment is in the US the concentration of the market returns. But because of the way we invest, we don't have significant concentration in those companies that are dominating the markets. But what that means is that whenever a market is concentrated in a particular sector, I always think there's more risk. Because that sector could go out of fashion, there could be some political or regulatory actions taken. So I think that the market concentration is a risk for us today. I think that there's also geopolitical risks that with the US elections, I think there's tensions today that maybe weren't there 15, 20 years ago. Interest rates and inflation is just one thing we're constantly worrying about and thinking about. And there's also two schools of thought. AI is going to get rid of inflation, or global politics and trade will drive inflation. So it's a difficult place to navigate for us at the moment. On the private markets, you've seen huge amounts of capital come into the private markets, whether it's equities or credit. Wherever there's low barriers to entry and money floods in, returns can always suffer. So for us, it's picking our way very carefully through the opportunities and making sure that whoever we back has got some form of competitive advantage in their space. So it's more complicated. There's more money washing around. But when out of chaos always comes opportunity.
And you mentioned AI there. Could I ask you where you stand on the AI? I can't go a conversation without AI nowadays, it seems.
Do you know, it's super exciting, the development, and there's all different schools of thought, but to my mind, it's a bit like electricity. Everyone's going to use it. We're not entirely sure who the winners and losers are going to be. There's a huge amount of excitement around, I think it's large language models. A lot of money has gone into that. But again, history, in the late 1990s, early 2000s, a huge amount of money went into infrastructure that really helped the internet and in this and cloud computing eventually come good. There was a lot of money wasted. There was a company called Global Crossing that built out cable under the Atlantic, went bankrupt. So I think you'll see real winners and losers in this. I think, of course, the big tech companies are perfectly placed to benefit from this, but products and synergies and new things will arise from this we can't even imagine at the moment. So I'm quite excited about it, but I think that you've got to really find something that's going to make cash returns to be super excited about it. But in 5 years' time, we'll be saying, well, that was obvious.
And looking back then at your investment career, are there any favorite or best investments or worse investments that you made that you look back on?
Oh yeah, I made a lot of terrible investments, I'm sure. I think two things to think about is venture investing. So we started that in the mid to late 90s at Wellcome Trust when nobody really knew what it was. That was super successful for the Wellcome Trust and has been successful for Oxford as well. It does require a lot of patience. I think one thing, other thing to say is that patience is completely undervalued in this business. And we've backed managers that have had at periods terrible performance, but we stuck with them because we understood why they had terrible performance. That is perhaps another thing I'm really proud of, is so having the patience with venture capital and sticking with managers over a long period of time, even though there be periods of poor performance. And I know that you pick stocks within your group, and sometimes companies will go through, bad periods. But if you understand those businesses, understand the management team, understand the sectors, sometimes it can be a buying opportunity as opposed to just quickly selling because it's uncomfortable. So sometimes investing is uncomfortable.
And what would you say the biggest differences would be between investing in public markets and private markets?
So in public markets, because you have a price every day, you really have to have the stamina just to ignore that, because it's like you're having someone shouting in your ear every day. In private markets, you have a little bit more time. You can go to the library and study.
Okay, I
You've
like
got more
that.
time. So I think it's that there's more time, there's more patience, there's less noise in the private markets. But in public markets, I think it just takes a lot more stamina because every day the market's telling you something that you may not agree with. So actually, I think public market investing is really tough.
And looking back at how you would manage risk in a portfolio,
So
are
for
there any
us,
other?
so for us, there's lots of risks. So we're global. So we have currency risks. We have to make sure that we're not too much money with one individual. We have to make sure that we don't have some sector risk that we're not aware of. Liquidity is a big, when you've got a big private portfolio, you have to really carefully manage your liquidity. We don't tend to manage to traditional risk measures overall in the portfolio, such as beta or correlations, but we do have different parts of the portfolio that we want some diversification. So we closely watch the overall beta of those strategies and that part of the portfolio, because they may be assets that we've invested in that we want to be able to access in periods of market crisis. So our theory is they won't go down as much as the equity markets. So we have to really closely track their overall relationship with the equity markets. And volatility, you always have for particular individual investments expected volatility. Is when something becomes more volatile than you think it will be, that can be an issue, but it's less of an issue for the overall fund because it's so diversified.
And your first and looking at private markets, your first commitment to a private equity fund was back in 1995. How
Yes.
has the private equity industry evolved from your experience and your view, and where do you see the industry going forward with higher rates now?
So I think that there's a lot more people investing. So, the number of private equity funds is incredible. The number of investors in private equity today is incredible. It was a little bit more of a club when I started. It wasn't well understood. It was perhaps access was a little bit easier, but your choice was a little bit more limited as well. I think that for strategies dependent on cheap rates, it's going to be tougher. I think smaller, nimbler managers that don't rely just on leverage will continue to do very well. But I think at the larger end, returns will be a little bit more challenging, but you should get some form of illiquidity premium, and if you're not, don't do it. Stick to the public markets.
And in private equity, but also could be venture capital as well. Are there any sectors or industries which you're excited about for the future now?
So we don't tend to invest by sectors within private markets. It tends to be very much driven by the talent. But we always find biotech super exciting. We tend to do that in more hybrid strategies because the public markets in biotech, particularly in the US, are quite private equity style anyway. There's a lot of young, fragile companies that are going to need follow-on financing. So we find biotech really exciting because just of all the innovation and developments that are going on in academia, new drugs, new ways to screen drugs, AI is going to be, really helpful there. So I think that there's always a lot going on in biotech. So that means that, it can be a tough place to be for a long period of time, but when it works beautifully. So you've got to have a strong stomach for biotech. But we think that's really the only area where we have a particular sector focus.
Now, I'd love to talk about talent because you've spoken a lot about this and especially diversity. And I have a sort of two-part question. The first part would be when you're going to visit a fund or a potential place you're going to make an investment, what do you look for? I remember reading in Peter Lynch's book, One Up on Wall Street, he would have this kind of list of questions he would ask management. What are the questions you're asking, the fund manager? And then also for someone that's going to work for you, what are you finding on your own investment team that you think are good qualities?
So the key thing we don't have a list of questions, but that we ask the managers, but we have a list of things that we need to know. And so I was with a venture fund, and they're in a particular area of they're a seed investor. They invest in deep tech. It's really important for me to understand that they understand deep tech. They understand that it takes a long time as a seed investor to create value for an investor. So how do they think about that? What is their integrity like? Let me understand how your interests are aligned with ours. Let us understand, and we do this through a lot of diligence, how entrepreneurs think about you as a venture investor. How do you think about your LPs? How do you communicate with your LPs? How do you think about these people that are giving you that capital? So a lot of it is about personal on something like venture. Where there's more quantitative information, so it might be a public equity manager, it's really understanding how they analyze businesses, how they think about risk and return, how they put a portfolio together, when do they buy, when do they sell, when do they let things ride? When do they, cut things off? We always like to understand how much of their own money is in the fund. We obviously have to understand who makes the decisions and how they make the decisions, and how they think about mistakes and how they mentor their team as well. So there's a lot of things that go into that, as well as we like to understand that they are running their business as well, as well as the investments as well.
And through all your time meeting so many different types of investors and funds, are there any patterns you've seen or kind of degrees you think that are great from these investors or personal qualities?
So the very best investors have a very narrow focus and really don't care what other people think.
Those are
And so the very best investors that we have are very focused, don't stray from what they know. They do it brilliantly. They're all intellectually curious. How does this work? Why does this work? They're quite happy standing out from the crowd or not listening to the crowd. And really good investors do their own research.
And you mentioned mentorship there as well. How do you foster mentorship within? Yeah.
So it depends on the level. So at the end of this year, I will step down as CIO and just be CEO. So my CIO in waiting. So my role for him is to nudge and guide. For our investment associates, I will spend time with them. We'll talk about ideas. So it's, I still try and guide them. I won't tell them what to think of their ideas, but I'll say, well, I was talking to one of them the other day, and he said, do you remember we were talking about that investment? You told me just to go and do more research and think about research in here. He said, I did. So I realized it wasn't a very good idea. If I had told him that wasn't a good idea, he wouldn't have learned anything. So you have to just sort of guide people to finding things out themselves, because that's how people learn.
And there's so much information out there. I feel public markets are a lot more accessible for just your average day investor in our student fund. But given there's so much information, I'd love to know on a personal basis as well, what is your routine looking like when you're for reading, whether that be news or investment books? What does your consumption of information look like?
It's quite interesting because I was thinking about this question. I learn from talking to people and reading not investment books, but a lot of what people I respect write about. So I know you've had Howard Marks on. He always makes me think. There's some good financial journalists, particularly in I don't get myself into trouble here, but there's some good financial journalists who take time to think about the markets and solicit ideas. There's particularly a couple in the US who I really enjoy their columns, and they're always looking for their readers' suggestions. I like to read The Economist. I think anything that makes you step back and look in. But I think that it's just talking to lots of people, getting lots of information in. Our managers are great sources of information, our board, our investment committee, other investors. You're constantly sense checking your own ideas. I think you just have to be a bit of there's not one source. You just got to be open to many sources, because you're never quite sure where the idea is going to come from or where the early warning signs are going to come from.
But will we be seeing a Robertson memo coming soon? Like Howard Marks has his memos?
I wish I could write like Howard. No, I think I'd only get myself into trouble if I published my memos.
And going back to qualities of being successful in investing, what other qualities do you think are, or rather not qualities, but skills you think are important to start developing early on?
So really good corporate finance skills, really understand how businesses work. really get to grips with a profit and loss account and a balance sheet and the 60 pages of notes on any financial statements. I think it's really important that you understand that for a good investor, because ultimately, at the end of the day, you're investing in businesses. But that's if you want to be, if you're interested in owning businesses, there's lots of different things to being a very successful investor. But for us, we're more fundamental investors. That would be what I'd say. I'd also say, as you progress in your career, good advice that I was given was seek forgiveness, not permission. Just keep going until someone tells you not to.
Wow. Okay. And going back to talent and diversity of talent specifically, I've got 3 younger sisters myself. They're starting to become very interested in investing in finance. And I told them I'm going to be speaking with you. I've sent some stuff, and you're an inspiration to women in finance. But I'm wondering, how do you get more women to become interested in finance? And how do you kind of foster diversity in a team as well?
So I think diversity of thought is super important, and the most important thing in an investment team, so that you don't have everyone who have similar views, and that you have people that are brave enough to discuss their views. And that's really important, because it's a very iterative process that we're constantly looking for why you could be wrong about something, and respecting people's views along that journey. I think investment gives itself a bit of a bad image. There's lots of super successful female investors. They don't tend to be as visible. I think that might be the issue. I think that investing is intellectually challenging. It's an incredibly rewarding place to be as well, particularly in our area for managing an endowment. We can see the real impact of the money we make. So I think that could be more of an attraction, where you can see the real world impact of the fruits of your labor. And that may be more attractive to, some parts of society than just money for money's sake. And it's certainly been there's really nothing more satisfying than when I go out and talk to a professor and they talk about the impact the endowment has had. Or talk to one of the college bursars and they say, well, the endowment bought that new roof. So I think that there's lots of different ways into finance. There's lots of different ways into investing. There's a lot of women. You just kind of have to hunt to find them.
And going back to what you said about sort of succession and how now you're going to be stepping out of the role of CIO and focus on the role of CEO, what does succession look like? And what would your advice be for people conducting succession? I mean, the student fund, every year we have to appoint people in new positions. What is your advice from your experience?
So what I'd say is, that's quite hard every year. Goodness me, I'd be exhausted. What I'd say is that I've seen lots and lots of different investment management firms handle succession in different ways. So when it came to my succession, I had the benefit of watching what worked and what didn't work. And I think it's been quite a long, gradual process. And Niamul, who's taking over as CIO on the 1st of January, has effectively been doing the job for the last year to 6 months, but maybe with just a little bit more round of a framework than he will have on the 1st of January. So, Niamul's had a long interview process for this. So I think take your time, make sure you've got the right person, and then gradually over a period of time, just give them more and more responsibility so that it's seamless and it's not a shock to the business or the team.
And I suppose now, wrapping up, if we could look at advice for students, if you were to turn back the clock with all the information you have now, what would you say to your younger self? Or what extra advice would you perhaps give?
be open to opportunities. Don't be too fixated on going to a brand name. And take every opportunity that's given to you, and don't worry too much about it. I think can often be a little bit too much overthinking things. Just step into something, because you never know what opportunity you're going to get. And I would never have said I want to go and work for a charity when I graduated. The Wellcome Trust was a charity. Who would have thought? But I took that leap, and look where it's led. It's led. So, don't be afraid of taking risks with your career.
And if you had to advise on, I know you said right now specifically that there's no books that are incorporated in your daily reading, but in terms of books you'd recommend throughout your life, finance related, non-finance related, are there any sort of books or pieces of writing which you found were influential?
I think if I put it down to somebody that I've consistently read throughout my career, it is Howard Marks's Letters. Does it inform how I invest? I don't know, but I love his constant challenging of the status quo.
Absolutely. And one final question, advice for our society, our student fund. If you had to give one final message from this conversation I've taken, patience, contrarianism, are there any other key pieces of advice you'd give to the listeners at Trinity?
Don't overcomplicate it. Honestly, keep it simple. Don't overcomplicate it.
Okay, for everything, for the research, for the pitch, and for...
Yeah, you have a limited time. You have a year. Get the most out of it, and don't try and overcomplicate it by too many rules.
Okay. Sandra Robertson, thank you so much for the time.
Well, thank you.
You have been listening to the Trinity SMF podcast. You can find more of this podcast on our website, www.trinitysmf.com, and follow us on our social media to find out more about the podcast releases, upcoming events, and much more. Thank you again for listening, and stay tuned.